Hello, welcome back. I hope you're having an awesome Saturday. I am back after a little while. I have been moving to a new apartment lately, so it has been a little bit hectic. And I'm preparing for new videos, pretty much creating a mini studio here in which I'm gonna be recording videos with my face. So you're gonna be seeing myself shortly. But before I move to these new videos, this new type of videos, I'm going to be refreshing our analysis of well-known stocks, FANG for instance, tech, and some other well-known companies that and popular ones that people are actually interested in. Before again we move on to some other new types of videos, I'm going to be refreshing because it's been a little while. So stay tuned for a few videos about the top companies here. We're going to be starting off with Meta, and Meta is a company that I have long said that I really like, and I am an owner myself. And at some point, remember, it was below 100, it was near 80 or so. If we take a look at the 6 month chart, you can kind of see it here, like 90, 88. So a huge bargain. And then in like 3-4 months, it came back up to $212, as you would expect eventually for a company of that sort. And there are many reasons for this one that we're going to be talking about in this video, plus pretty much examining the company's financials in a little bit more detail. And I have added more years of financial data recently to our tool, which I'm going to be showcasing a little bit later. Now, the P/E ratio of the company and the price to free cash flow have been a little bit elevated. Like, as you can understand, they were near almost 10 to 15 at some point, earlier this year or the previous year, late months. But you will see that we're still sitting at a 24 and 28, which is a little bit spicy, but it may be good enough for a company of this caliber. Because remember, just having a high PE ratio and a high price to free cash flow ratio, unless it's like too high, it may still be a potential buy, especially if the company is growing nicely through the years and keeps growing nicely, has nice growth numbers. If it has great margins, all these things matter. And they do matter because they lead to better gains. And also, the other things that matter is what has been happening lately with the company. And in order to understand that, you can always take a look at our stock news module here, which can very nicely summarize the story of the company. This is what I really love about this module here in our tool. The fact that I can take a quick look and take a quick peek pretty much and pretty much get a summary of what has been happening in the past few weeks. And as you'll see very quickly, you will see that Meta's new focus on cost cutting is impressive. I don't even have to read the articles here. So says Rosenblatt's Crockett. And as you can understand, these kinds of news we have potentially heard about. Maybe you have heard about Meta is actually cost cutting. They have been laying off some employees. Another one here, Meta workers grill Mark Zuckerberg over executive bonuses amid layoffs. So Meta has announced quite a few layoffs here. About 10 billion, I believe, was 10,000 employees was the next one, the next phase of their laying off, I believe, is what they said, and they will be slowing hiring as well. And the thing is, you may be thinking that this is bad for a company, right? I mean, like they are laying off employees, so they have to cost cut. But the thing is, this is music to investors' ears, and the reason for this is the fact that when you are laying off people, of course, it's bad for the overall economy, sort of, and the government obviously doesn't really love that, and people, of course, don't like getting laid off. But the thing as an investor is that you're cutting off the slack. And so you're cutting off the fluff, I should say, not the slack, because you were having extra expenses, especially during the period where the interest rates were low and every business was booming. All these companies, especially tech companies, have been overhiring, and so now they're cutting out the fluff. And when this happens, you're potentially going to be getting more money for investors, and this is why investors salivate over this news. And one of the core reasons why the stock has been climbing tremendously in the past few months. Again, from almost $80 to 212, massive increase of the stock price. Now, in terms of the outstanding shares, the company's outstanding shares have been also going down, which is a fantastic thing, and they still keep buying back shares. And I love that as a shareholder that I am myself, because now my shares are actually worth more. There is less of them. My shares are actually a larger piece of the pie, of the overall pie of the 2.6 billion outstanding shares, which could potentially go to 2.5 or 2.4 as they go down in absolute values. This is what I love to see, because again, my stocks are actually going to be worth more intrinsically. So I have a larger piece of the company pretty much, even if it's like a very small percentage. Now, the company has very few liabilities compared to the free cash flow that they're generating, about three years of last year's free cash flow to pay back all the total liabilities that they have, which is fantastic. Very little debt here, very little liabilities overall. And margins that are great, about 20% here, they have been going down recently because the profitability has been hit, as you'll see also here in our net income growth. It has been going down. This is known things. It has been happening during COVID. Known things about companies, they have been suffering, especially tech companies, they have been definitely suffering quite a lot. And this is why we got fantastic prices as well. One of the core reasons why we got fantastic prices. And we can buy cheaper, and we had the opportunity to buy even at 80 something dollars, which is fantastic. Of course, you can never know the bottom, but you could have bought along the way pretty much if you were up to speed, if you got up to speed, were caught up to speed with developments. Now, what I wanted to take a little bit of a look at and kind of tell you a little bit about it is the insider trades. Here and there, sometimes I use it in my videos. I don't want to go overboard with all the tools that we have here because there's quite a few of them in our tool. But you will see that overall there's like conversions and a little bit of sales here. As you'll see, this is the red ones as sales. And conversions is actually options pretty much. What you kind of want to see here is whether there is insane amounts of sales from potentially the CFO, for instance, the Chief Financial Officer or the CEO, and kind of see how much they are selling and if they are selling too much. Like this can give you a little bit of a sort of like raise an alarm. Why are they selling so much? Or if they are buying too much. Like usually executives don't really buy, they get given their stock as options, for example, or pretty much handed to them as RSUs, for instance. And you will see here, and what I always want to examine is what is the financial officer doing? The chief financial officer here, like Lee Susan, you will see that she has been selling and pretty much converting some of their securities, but it's not a huge piece of the pie. It's not like she's selling everything or converting everything. It's a little bit of the total here of the securities owned in total. It's not like they're selling everything here and pretty much jumping off the ship. Now, executives will sell quite a lot of shares because it's their compensation. It's a huge amount of their compensation. It's how they're getting paid. And I myself, when I was working for a company of that sort, I was pretty much selling my stock, my RSUs, almost the moment I got them. So imagine if you're getting like $1 million worth of this stock, you're likely going to be selling it because it's compensation. Now, if you're getting 7 million, 10 million, 14 million, like people of this sort, who are getting tremendous amount of stock every quarter, pretty much, then you may not sell everything. And in most situations, especially if you believe in the company, you are going to be keeping some and just selling a little bit along the way. So this is what this module here gives you in our tool. It kind of tells you whether there is panic among the financial officer, for example, and maybe even the CEO in some situations. You can, of course, gain access to our tool here. Every patron, by the way, has access to our tool. If you are interested in becoming one, you can visit our page or pretty much visit myinvestorsheaven.com. You will find a link to that, and you can have access to all these tools that I'm using here. Now, the next thing that I want to take a look at is the financial statements, the income statement, for instance. And lately, I have added the ability to see 10 years of financial information. And it's amazing to see how much Meta has grown, right? It's insane. From 7.8 billion, like 10 years ago, now they're making 116. So stop and think about that for a while. Take a look at these numbers here. It's only like last year where they just barely lost a little bit in terms of revenue growth. And overall, they have been pretty much increasing their value at a tremendous pace, increasing their top line pretty much. Take a look at this one. This is tremendous here. Absolutely insane. Love to see that. Now, as the company is growing at tremendous pace and at pretty high numbers, it's getting tougher to grow. Like over here they had 58%, over here they had 21, for example, even though this 37 is still pretty high. But eventually, as the company is making more billions and more billions and more billions, it's getting tougher to grow. So they are not going to be growing every year at 40% rate, at a 40% rate. That's not going to be happening. But I do think that they are going to be growing at a nice pace, maybe 8%, 10%, maybe even more in the upcoming few years. And of course, you can kind of see here in the net income from 1.5 billion to 23 over here, and 40 pretty much was the normal. It's just that they had the issues that we talked about, and we have talked about in previous videos with what has been happening with the tech companies and overall the economy pretty much. The balance sheet actually tells you the same story here. Again, I can use 10 years of display, and you will see that the total equity of the company from 15 billion to 125 billion, absolutely amazing for the company. And of course, you will expect some of extra debt as well. As the company grows, as they're getting more assets, it makes a ton of sense to be getting more debt as well. It's leverage. You can use that to leverage and grow even more. So that's very, very normal here. But it's amazing how much the company has grown here. It's absolutely tremendous. You can kind of see it in the current assets, not non-current assets. The tremendous growth over here through the past decades. 4 to 126, that's the long-term assets, the total non-current. Absolutely insane. Awesome. And what about the cash flow statement? Again, we can take a look at the 10 years of data. Same thing. And you will see that the free cash flow of the company from 2.8 billion to almost 20 billion here and 40 again almost last year. Now remember that they had a lot of expenses just because of capital expenditures. Remember, metaverse, 31 billion over here. So this is why this number is much less than the previous year. But still, the money is there. It's the way you use it. It's the way you utilize it for expenditures. And it looks like they are cutting down on metaverse costs, which is nice to see. And frankly could propel the stock even higher in the upcoming few years. Now, the core thing, the stock evaluator, our discounted cash flow model. What are we going to be doing here? Like last year, the company didn't really grow, but overall, they have been growing at a fantastic pace. Now, we got to be a little bit careful. We don't really know what's going to be happening in the upcoming few years. This is a 5-year model. So I'm going to be conservative. I'm going to go 5%, 8%, and 10% here, relatively conservative. And the net income margins that I'm going to use, typically the company has more than 20%. So I'm going to go, I'm still going to use 20 for the worst case scenario. And then I'm going to go with something that's much more normal, I think, for the company eventually to get back to these levels, 25 and 28 over here. And the free cash flow margin that I'm going to be using, you can kind of see it over here. About 90% is the average, as you'll see here in our numbers. So I'm going to be using 80, 90, and 100, since 90 is the average. An annual return of 13% is what I typically ask for in my tool and my investments. Pretty much, I want to get the 13% back at least from my investments in individual stocks, that is. And you can kind of see here that with these values, we are looking at a stock that is a little bit, a little bit more spicy than some would like. But I actually do think that the high projections are the ones that make the most sense, frankly. And these ones are much more conservative here. Even the medium may be okay, but I think the high ones are the most logical, to tell you the truth. And even these could be a little bit conservative. Like the company could still achieve maybe 15% in the upcoming 5 years, eventually, in total, that is. They may have a bad year, but overall, I think 15% per year is something that they could be achieving. And if we're looking at the medium ones, we're sitting at 186. Obviously, this one is a very, very low risk scenario. And 186 also makes sense, and it's not that far from our current price. And the thing is, again, remember, when we're looking at 186 and the current price is 212 over here, and it's not that far from our pretty much what we wanted to achieve, we have to think about the company as a whole, right? About what is happening overall with the company. It's a company that doesn't have debt, a lot of debt. It's a company that's making tons of free cash flow. It's a company that is growing their top and bottom lines at a tremendous pace, and their total assets as well. And it is a company that is also buying back shares. So there's a lot of positives here, and obviously it's a company that has it's actually a huge advertising company, and it has a tremendous amount of employees and a tremendous amount of, I should say, customers, frankly, or clients. And they keep growing. And almost half the planet is using Facebook. And it is a company that I think is going to continue to do well in the upcoming years. And I do think that even at this valuation here, this projection here, and even if this is red overall, because of the company's value, I'd still consider it a potential buy near 200, 210 even, for the upcoming years. Now, of course, if you could get it at a cheaper price, more power to you. But if you didn't, I think it may still be an okay buy. You could have a little bit of an up and down for a while, of course. It could go back to 180, who knows. Or it could continue upwards, nobody really knows. But over the next few years, and even more so in the next decade, I really think that the company will surpass the $1,000 back, the $1,000 range. That's what I think. Of course, I don't really know whether that will happen, but I do think that the company will grow to that level in the next 10 years, probably even earlier, much earlier, frankly. But yeah, that's what I wanted to talk about in regards to Meta. Next up, I'm gonna be following with Apple. To tell me what you think about the company and whether you are looking about potentially getting it yourself, getting the stock if you don't own it. And I'll see you in the next one. Again, remember to like and subscribe and be around because there's going to be a lot more videos about tech companies and again popular companies. Again, before I move to the new type of videos that I'm gonna be making, and I'm gonna continue making these kinds of videos that I'm making here as well. But I'm gonna be showing my face and hopefully making better like story-like videos that you are going to enjoy and you are going to be entertained out of, hopefully. And you're going to get a chance to see me as well if you are interested. It's been a while that I have been working on this channel. Thanks for watching, and I'll see you soon. Bye bye.